I don't have your money here. It's in Bill's house and Fred's house.
Welcome to WatchMojo, and today we're counting down our picks for the top 10 awful truths the banking system doesn't want you to know.
This is what happens when we have politicians who cater to Wall Street instead of working families.
For this list, we're looking at open secrets about the banking system. Are there any skeletons in the bank vault we missed? Let us know in the comments below. Number 10. The FDIC has limits. During the Great Depression, one of Franklin D. Roosevelt's first actions as president was to get Congress to create the FDIC. The Federal Deposit Insurance Corporation insures bank deposits. That insurance provides consumers with confidence that their money will be protected if a bank goes under. As we learned quickly during the SVB collapse, FDIC insurance isn't perfect.
We're here for the bank's money, not your money. Your money is insured by the federal government. You're not going to lose a dime.
As of writing, the FDIC is only required to cover up to $250,000. The government chose to backstop full deposit amounts at SVB to avoid contagion, but there's no guarantee they'll do so in the future. Other investments like bonds and stocks, T-bills, safe deposit boxes, and annuities are not covered by FDIC insurance at all. Number 9. Shadow banking is an unregulated Wild West. A large, unregulated series of structures and institutions underwrites the global financial system. Known as the shadow banking system, it's often directly connected to turmoil within the banks.
All the signs were right. Shadow bank account, movement patterns. Guardian should have been here.
It includes financial intermediaries like hedge funds, private equity firms, large investment banks, and mortgage lenders, as well as unregulated activities by otherwise regulated organizations. An example of the latter are credit default swaps, which were responsible for the 2008 financial crisis. These systems and activities generate an unbelievable amount of wealth with little to no global oversight. According to the Financial Stability Board, shadow banking accounted for almost half of all financial assets in 2021. Without regulation and oversight, it's not a matter of if shadow banking will cause another global crisis, but when.
And then that happens.
What is that?
That's America's housing market.
Number 8. Global finance is vulnerable to cyber attack. In this brave new world of modern technology, personal information is at risk 24/7. With banks, the threat is doubled. They can access much of the same personal information as social media, but also house all your financial data. The Experian and Capital One hacks may end up being the tip of the iceberg. In 2020, the Financial Stability Board warned that a, quote, major cyber incident, if not properly contained, could seriously disrupt financial systems, including critical financial infrastructure. Virtually all bank information and money is digital now. At the click of a button, anyone's money could just vanish.
300 million to $1 billion stolen. It's all about remote access Trojans and spear phishing attacks.
The entire global financial system could grind to a halt. According to one cybersecurity firm, financial organizations around the world faced an average of 700 cyber attacks per week in 2022. Number 7. Money laundering is a $1 trillion industry. A 2009 UN report estimated that money laundering accounted for 2.7% of global GDP, or $1.6 trillion. It's only gotten worse in the years since. Investment banks in countries with low transparency are hubs for criminals to wash their money. The process of laundering money involves 3 steps: placement, layering, and integration. Placement puts dirty money into the global financial system. With layering, criminals conceal their tainted income streams using accounting tricks and financial transactions. Finally, they reintegrate their money after it's been cleaned.
Nice, clean, taxable income brought to you by a savvy investment in a thriving business.
Banks will often do the minimum amount of work possible to suss out laundering among their client base. A prime example was HSBC in 2012. They were found to have laundered $881 million for Mexican drug cartels. Number 6. Banks love hidden fees. In 2022 and 2023, President Joe Biden called on Congress to go after junk fees with legislation.
Today's actions are going to save consumers more than $1 billion each year. And that's a lot of money
back in people's pockets.
He also directed the Consumer Financial Protection Bureau to study them and crack down. Banks are some of the worst offenders out there, having received virtually no scrutiny until recently. They love to nickel and dime their customers in every way they can to generate profits.
You control the debt. You control everything.
In 2020, U.S. banks made over $12 billion in overdraft fees alone, down from $17 billion in 2018. For banks, it's basically free money.
Oh, it's on the house.
Really?
Yeah, every bounce check costs us $20 in bank fees.
They've snuck hidden fees into every nook and cranny of their products they could find. Unfortunately, these minimum deposit fees, withdrawal fees, and debit card fees tend to target and hurt working-class customers the most. Number 5, bank lobbyists are powerful. The influence of lobbyists on American politics has been a problem for decades. It's become a cottage industry, and since the Supreme Court's Citizens United ruling of 2010, business has been booming.
Can you name one time in the past year where you checked the tape and you didn't give the banks the AAA percentage they wanted?
Between the 2016 and 2022 elections, the banking industry contributed almost $200 million to American political campaigns.
You go to a breakfast fundraiser in the morning, then you go to work, you do your job, then you go to a lunch fundraiser, then you come back, then you have another committee hearing or a markup.
Though they do contribute to both parties, the banking industry spent money nearly 2-to-1 on the GOP in 2018. Perhaps it's a coincidence then that 2018 was also the year that a Republican-controlled Congress and president deregulated their industry. According to one IMF study, there is a direct connection between industry lobbying and the global weakening of regulations. Number 4, U.S. banking regulations were weakened in 2018. After the 2008 global financial crisis, President Barack Obama proposed sweeping reforms, and Congress passed the Dodd-Frank Act, designed to reduce the likelihood of a future crisis. In 2018, a Republican Congress passed a bill with bipartisan support to weaken those regulations.
So I'll be signing now a very, very important bill from the standpoint of people and jobs and loans and getting out there and building a business.
Smaller banks were taken off the list of companies subject to stress tests, higher capital requirements, and enhanced prudential standards. Essentially, mid-tier banks like SVB were allowed to be less prepared for emergencies. As the nonpartisan Congressional Budget Office declared at the time, the bill, quote, increased the likelihood that a large financial firm with assets of between $100 billion and $250 billion would fail.
The Dodd-Frank passed, then people started coming around to politicians' offices, offering them corporate PAC checks and lobbying them to repeal those regulations.
Though not completely responsible for SVB, banking deregulation makes crises more likely to happen, and worse when they do. Number 3, systemic racism in banking is a major problem. People of color have never had equal access to banks or the capital necessary to gain economic mobility. In every way that banking touches American life, it's deficient in minority communities. According to the Brookings Institution, there's a stark contrast at the local level when it comes to access to credit. For example, there are fewer bank branches in Black and Hispanic neighborhoods. Loan interest rates are on average worse for Black and Hispanic customers. Most importantly, mortgages are also harder to obtain.
There's a few complexities you just left out. Like, we Black, and this goddamn bank is in Texas.
Since the 1950s, home ownership was seen as the pathway to the middle and upper classes. Home values tend to increase over time, providing wealth for future generations. Home ownership and loan access are some of the greatest contributors to the racial wealth gap. Number 2, banks are only as strong as our confidence in them. The collapse of SVB is a prime example of the role consumer confidence plays in banking.
It's confidence. So it's confidence.
In many ways, banks are an illusion. Their job is to take deposits, pool the money, and lend the money out to make a profit. But banks don't need cash on hand to cover every deposit. That's why a drop in confidence can lead to disaster.
Americans can have confidence that the banking system is safe. Your deposits will be there when you need them.
Had confidence not been tested by a bank run sparked by a small band of ultra-wealthy investors like Peter Thiel, a collapse may never have happened. But SVB didn't have enough cash on hand to cover withdrawals, so they failed.
What do you mean the bank is out of money? Insolvent?
You only have enough cash for the next 3 customers!
Low confidence and bank runs can spread like a virus, causing contagion and disaster throughout the sector. Before we continue, be sure to subscribe to our channel and ring the bell to get notified about our latest videos. You have the option to be notified for occasional videos or all of them. If you're on your phone, make sure you go into your settings and switch on notifications. Number 1. Your money bankrolls the bank's gambling. The purpose of a bank is to take and hold the money of its customers and generate profit. Typically, that takes the form of fees, loans, or mortgages. But banks also like to invest to make larger profits. As with any gamble, a bad bet can lead to ruin.
Let's bet it all. Double or nothing.
In 2007 and 2008, the bad bet was subprime mortgage-backed securities that went bust. For SVB, it was U.S. Treasury bonds that tanked when interest rates went up. In both instances, banks took our money, gambled with it, and lost. When a bank collapses, the options aren't great. Since 2008, hundreds of banks have failed, although the rate has calmed down since the aftermath of the global financial crisis. Time will tell if that remains true in coming years. Did you enjoy this video? Check out these other clips from WatchMojo, and be sure to subscribe and ring the bell to be notified about our latest videos.